All right, guys, today is day 5 of the road to mastery, to part-time trading, part of the 30-day challenge here. Today, we're talking about um, risk management, like we talked about yesterday. But now we're going to talk about managing your overall account rather than specific trades. Yesterday, we were focused on specific trades and setting stops for those trades. And that's what most people focus on when they think about trading their accounts. But you also have to think about the big picture and your overall account. And this is a part where a lot of traders don't really focus on and don't think about. And it puts into practice a couple of things we've already talked about in the challenge. But why this is important is, like we said yesterday, the lifeblood of a trader is your trading account. And you have to make sure that account continues to grow. And if you take a big loss in that account, you're never going to be able to grow it. And this is where traders normally blow up their accounts. So, when we think about that risk, we talk about 1% per trade. You can lower it or raise it based on, different conditions you're seeing or how much you like that trade. But generally, let's say we're around 1%. Now, we focus on that trade, but what if it's a market we really like and there's 10 stocks we want to trade and we end up taking 10 different positions? Now, you're probably thinking, well, okay, I take 1%, 1%, 1%, I'm protected. I've got all these different trades. But now, what if the market tanks? If the market tanks, you're basically screwed, because now instead of that 1% loss, all of these stocks are going to get hit together. So it's like one big risk pool. And you're going to end up losing at least 10%, probably more, because a lot of times when the market tanks, you actually sometimes will blow through your stops and you might lose, 1.5 or 2% of your trade. So let's say each one of these 10 trades you end up taking, you lose 1.5%. Now you've lost on that $100,000 account, you've lost 15,000 in one day. And that's hard. These types of things are hard to come back from. If it was 2% per trade, you've lost 20,000. And now it's like you're starting over. So we need to protect ourselves from that. So we always need to think about big picture, not just that specific trade, but overall, how are we trading? And there's a couple of things to do. I didn't even include this in the notes here, but also you might want to diversify your trades. I think about this a lot. If semiconductors are moving and I like a lot of different semiconductor stocks, I still won't take 4 or 5 semiconductor stocks, because if that area gets hit, it's really like one big trade. So sometimes you can diversify, like, maybe take a Facebook, maybe take a Google, and then take something completely different, like a commodity stock or a bank stock. And that helps protect it as well. But you always want to be thinking about the big picture. That's one way to fix it. I actually didn't include in the notes. But what you want to do is, what I always do is I start off the week saying, what is my overall risk parameter? Now, generally, I don't want to be risking more than 4 to 8% of my account at one time. So if I've got a $100,000 account, I don't want to be risking more than 4 to 8,000 at one time. Maybe I'll increase that a little bit at times, but that's generally where I am. It's a risk range that I think about for my account. Now, how do I decide if I'm going to be on the 4% level or the 8% level? The way I do that is I think about what kind of market it is we're in, and I'll say to myself, okay, here I'm willing to be at 8%. This market, I'm only willing to be at 4%. So, and I've laid it out in the notes. If it's a really strong market that's in the middle or the beginning of a trend, I will get really aggressive. And we're actually in this market right now as of June, where we've been pretty aggressive. June 2018, depending on when you're going to end up watching this video. So we're on the more aggressive side, around 7-8%. I've been willing to take more positions and increase my risk a little bit on these positions. Now, if we're in a strong market and the market starts to get overbought, which we're actually nearing now, then I'm going to pull it back some, because now we're in a spot where the market could pull back hard and we don't want to get crushed out of these positions. So now, instead of being at 8%, I might take a few positions off. It doesn't mean I'm going to totally get scared and stop trading, but I'm going to err on the other side of the risk ratio and be at maybe 4 or 5%. So that's the way I'm thinking about these. That's for strong markets. Now, in a weak market, I'm always going to be in that lower range, maybe even 3 to 4%, which we were in about a month ago. But then if the weak market gets very oversold and I think we're ready to bounce and maybe we're getting some internal market conditions that are telling that, and we talked about that a little bit when we talked about analyzing the market in day 1 or day 2 of the challenge. So you can see how important that analyzing that market is in terms of what we're doing. Now, we're already starting to put some things together, even though we're only on day 6. But if we're in a weak market, but I think it's going to strengthen and it continues to strengthen, then I might change it from 3 to 4% to 5 to 6% to 7 to 8%. So these are my starting points, and then I decide where I'm going to be on that. It's always changing according to the market conditions. And then when I position size my stock, or when I decide I want to be, say I decide there's 5 stocks I like, but I only want to risk 4%. Then I know with each of these stocks, I'm not even going to risk 1%. Maybe I only risk 0.5 or 0.7% per trade. So as a good swing trader, you always have to be thinking about these. You're seeing now, it's not just setups. It's not just the trades you take. It's this overall picture of risk management, knowing what market you're in, and then adjusting your risk accordingly. That's why I often say we're risk managers instead of traders. So remember this. Now we've got an exercise where I'm going to take you to, and let me pull up the chart real quick. I'm going to take you back to here on Friday, February 2nd, 2018, when the market initially started to tank here. Then there was the big tank here. And I listed a group of 10 different stocks. You can pick any 10 you want, really. And imagine you took those stocks up here or even here. And what would happen to your account if you were holding these positions, 10 of them at 1% risk, and then you got crushed by the market here? You would have lost a lot of money. I just want you to think about that. And then I want you to say to yourself, during this period here, knowing that you were overbought, 0.2 on our list there, a strong market, but very overbought, how would you have adjusted your positions? Maybe you take less. Instead of the 10 I listed, maybe you only take 5 of them. Maybe you take a few more, but you only risk 0.2 to 0.5 per trade. And where would you have been on that risk parameter? Instead of 10%, do you adjust it to 8? Do you adjust it to 4? I want you to think about all these things. And as you do this, a light bulb is going to click. Yeah, I have to trade in a certain way because these kind of events happen all the time. And you have to protect your account from that, 2 or 3 times a year when that does happen, because that can crush your account. And then you're just going to be starting over. So keep that in mind. Now, tomorrow we're going to talk about profit taking, another aspect of risk.